Hello and welcome back to the American Dream Portfolio. In our continuing series on asset appreciation, we just investigated two asset classes, gold and bonds, to determine if they might have a place in the American Dream Portfolio alongside stocks of creative destructor companies. We learned that gold just made the cut, having an average annual rate of return slightly above our 9% target over the last 55 years. This result is due entirely to appreciation, not compounding, as gold produces no income. But there are additional criteria, besides rate of return, that must be met before we actually commit to any investment. We will discuss those criteria in a future video. We also learned that bonds can offer superior growth of capital during times of high but decreasing inflation, as was the case beginning in 1980. But those conditions don't exist today, as inflation has moderated to average levels over several decades. When we begin to construct the American Dream Portfolio, we will compare bonds to other asset classes to get hard evidence as to why bonds currently have no place in a portfolio that seeks growth of 9% per year or better. Now it's time to look at real estate. In an earlier video, we said that investors of modest means, even those living outside the United States, can benefit from American real estate for very little money. How is this possible? Isn't real estate expensive to buy and difficult to manage? It is indeed, but we have available a particular investment known as a real estate investment trust, REIT, which solves that problem for us. A REIT is a pool of money funded by any number of investors. As an individual investor, you place your money into the pool, and the managers of the trust use available funds to buy and manage a portfolio of real estate assets. There are over 200 REITs listed on major US stock exchanges, with a combined holding of over 500,000 properties worth over $1 trillion. As you can imagine, REITs cater to different investor appetites, from residential to commercial, from exotic vacation spots to bland warehouse facilities, and from locations throughout the US and around the world. If your real estate investment mantra is location, 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 you will probably find a REIT that suits your needs. That all sounds fine, but how much money do you need to invest in real estate this way? We will show you that a number of investment platforms allow you to take an ownership stake in a US-based REIT for as little as $1. Again, for as little as $1. When we said at the outset of this channel that our information is actionable for those with modest incomes, we meant it. But how do REITs stack up as far as investment performance over time? Do they achieve our 9% annual return target? Before we try to answer that question, let's digress for a moment to consider an important decision facing investors regardless of the asset classes that interest them. That decision is as follows. For those interested in stocks, is it better to purchase individual stocks or a fund that chooses the stocks for you? For those interested in bonds, is it better to purchase individual bonds or a fund that chooses the bonds for you? If you're interested in real estate, is it better to purchase individual REITs or a fund of REITs selected for you? The answers to these questions are for you to decide. However, when we begin construction of the American Dream Portfolio, we will compare composite investments such as mutual funds and exchange-traded funds with individual stocks, bonds, and REITs to help you make those decisions. Now back to our question about REITs investment performance. At this point, we think it best to assess REITs using a fund of REITs, rather than picking and choosing individual REITs. We will consider individual REITs in a future video. Meanwhile, the fund we selected to provide our first look at real estate performance is the Vanguard Real Estate Index Fund, a broadly based fund of over 150 REITs and real estate companies. Over the last 20 years, this fund, with dividends reinvested, has returned, on average, just over 6% per year to investors. This result is far below our 9% target. Therefore, in order for us to seriously consider real estate, we will have to look further than this well-regarded real estate fund. For now, let's return to the asset class we started analysing at the outset. Stocks. In an earlier video, we said that stocks are likely to be the workhorse of the American Dream Portfolio, and we would be delighted to capture the returns produced by creative destructor stocks like Microsoft, Nvidia, and Amazon. But it may also be wise to look for stocks other than creative destructors. Stocks that meet our criteria regardless of the reasons. After all, creative destructor stocks, in their prime and most productive years, may be more difficult to identify than we might imagine. Remember Ford Motor Company? We are unlikely to find a more life-altering innovator, but Ford taught us that, regardless of the impact a business has on our daily life, no company's stock can offer exceptional returns forever. With that in mind, let's take a look at the stocks of 3 companies that never achieved creative destructor status, but that have nonetheless offered returns that the American Dream portfolio would embrace. We'll start with Costco. Those of you living in the United States have undoubtedly heard of, and may even shop at, Costco. Although Costco is clearly a success story, it was not the first retailer to offer a warehouse club shopping experience. That distinction goes to Price Club, founded in 1976. Next came the 2 big players that were both established in 1983. Sam's Club, a division of Walmart, and Costco. Another major player, BJ's Wholesale Club, was started in 1984. Note that Price Club merged with Costco in 1993. All these retailers offer high-volume, members-only, competitive pricing in settings which would be considered massive as recently as the 1970s. But their innovations were more of quantity than of quality. They did not offer society a fundamentally new way of living as Ford or Amazon did. Nevertheless, Costco has been a wonderful stock to hold. Over the past 20 years, Costco stock has rewarded its shareholders with an 18% average annual return. This is superior to an aging creative destructor like McDonald's, which produced a 14.6% return over the same period. Our next stock, Caterpillar, manufactures construction, mining and engineering equipment. None of its activities changed the way we live, but its stock has averaged nearly 16% per year for 20 years. As such, it may very well have changed the way its investors are living, and it may also have a place in our portfolio. Finally, we present Comfort Systems, a company whose description, providing mechanical and electrical contracting services such as plumbing and HVAC, may put some people to sleep, even as its stock performance has risen to dizzying heights. None of its activities strikes us as particularly innovative, yet over the last 20 years it has produced an average annual return in excess of 29%. This surpasses even a dominant creative destructor like Microsoft, which provided a 15.7% annual return over the same period. So, what are we to conclude about the suitability of a stock like Costco versus one like McDonald's? The first company certainly saves people money, but the second company changed the way we live. To help answer that question, we'll introduce in our next video a concept that will be vital to our understanding of how to construct a hard-working portfolio. That concept is called the benchmark. See you then.